Hello everybody, this is Tucker Balch at Lucena Research. Welcome to our webinar. We're very pleased today to share with you one of our new data feeds called MultiExpert Factors. And this is in partnership with Nasdaq. We're very pleased to be working with them on this project. Now, big picture, we're going to spend about 20 minutes telling you about this data feed and the technology we use to make it possible. And then we'll take questions at the end. Along the way, I will pause every now and then to see if we have some questions and be glad to answer them. If you'll note on the GoToWebinar panel there that you do have the opportunity to input questions by text, and we'll answer them as we go along. Now, as we get started, I want to introduce to you Oliver Albers of Nasdaq. He's head of global sales and account management, and he's a center point in our partnership with Nasdaq, and we are part of, Lucena is part of what's called the Analytics Hub, and this data stream that we're about to describe is made available through the Analytics Hub. Oliver's been working with Nasdaq for over 2 decades, and he focuses on real-time and historical data. Oliver, why don't you tell us about the Analytics Hub?
Cool. Thank you, Tucker. And good morning, everyone. Thank you for joining us today. So first of all, for those of you who don't know Tucker, he has a really cool background as a former fighter pilot, kind of turned machine intelligence expert. On the other hand of the on the other side of the coolness spectrum, basically I've been living and breathing data for the past 2 decades, which isn't nearly as cool. But I have seen kind of, a vast amount of change in this arena in my history. I don't quite go back to the use of carrier pigeons, but we have kind of seen the evolution from the Gordon Gekko type green screen in the 80s to the rise of co-location and algorithmic trading, and really standard market data has become ubiquitous and accessible, not just by professionals with a Bloomberg terminal or Thomson Reuters terminal, but easily accessible by everyone via the web or apps. And as information, the standard market data that's out there is not all that encompassing and has never been the only thing investors need. It didn't give a lot of transparency in terms of future movements, didn't help investors understand things like intent, or really give them an idea about whether to buy, sell, or hold. In short, there was always an element of intuition and gut feel involved in investing decisions. You fast forward to today, and we're very much deep in the transition from kind of the gut feel investing decision methodology to more strictly data-driven investing decisions. And as part of that, we have more types of data than we've ever had before. I mean, we all hear every day about the use of satellite imagery, global shipping information, retail foot traffic, social media sentiment, web traffic, weather data. And we're still very early days as the Internet of Things and other technological developments have yet to fully evolve. So really, with the proliferation of these types of data, it's become a real challenge for firms to cut through the noise and determine what is meaningful for them based on their goals. So this actually results in new actual costs for firms to acquire these new data sets, but also opportunity costs associated with spending time on the wrong data. So to address this, we created the Analytics Hub. So we launched the Analytics Hub in May, really to make it easier for firms to use and consume these data sets. At the high end, it's a platform that leverages machine learning to validate, process, and normalize these new esoteric third-party data sets, and then combine them with historical market data and Nasdaq proprietary market data to create new, unique Nasdaq-derived signals. So basically, we've created a more efficient mechanism from a technological, contractual, and administrative standpoint, where the firm can work with one vendor, one validator, one relationship with all these different types of data sets for a firm to try. So as I mentioned, we launched in May and covered 4 inaugural data sets with Twitter sentiment, central bank communication sentiment, crowdsourced retail data, and technical analysis data from our own Nasdaq Dorsey Wright. And in July, we followed that up just 2 months after launching with 4 additional content sets related to corporate filings, retail trader sentiment, and then the 2 we'll hear about today with the MultiExpert long shorts and the MultiExpert long only. So, we're obviously very excited about the launch of the Analytics Hub and also about our partnership with Lucena. They've been there as part of this process before we even launched, helping us as a third-party validator of these data sets. And now we're really excited that we're leveraging their advanced machine intelligence to give clients new and unique insights into the market. So at that point, I'd really like to turn it over to Tucker to delve into the great work Lucena has done with the MultiExpert products that can help provide firms with additional alpha generation opportunities. So Tucker?
Thanks, Oliver. We'll also hope you'll be able to hang out to the end. We'll take questions at the end also. And so Oliver will be available to answer any questions you all might have specifically about the NASDAQ into this. Now, I wanted to talk a little bit about what is Lucena Research, because probably a lot of you are not familiar with us. We are a spin out from Georgia Tech. I'm a professor at Georgia Tech. I'm an expert in computational finance and use of AI in finance. And I've partnered with our CEO, Erez Katz, who has significant experience in developing cloud applications. And together with our team of 10 quants and other software developers, we've built this platform, QuantDesk, that enables us to analyze many various data sets and turn them into actionable intelligence. And that's one of the reasons for our partnership with Nasdaq, is we're able to not just look sort of at the raw data, but turn it into, as I said, actionable intelligence. More specific trade signals. Anyways, we're located in Atlanta, and we're very happy with our partnership with Nasdaq. Okay, let's get into the details now. The title of this data feed, the system we've created, is MultiExpert. Where does that come from? Well, lots of machine learning research has hinted at the fact that instead of just having a single model, it's much more effective to have an ensemble of models that work together. So what's an ensemble? It's a group of individual models that work together, and each of those models has been trained using machine learning. Why is it beneficial? Well, by bringing together multiple models instead of just a single model, we're able to create a more accurate overall system. And for those of you familiar with some of the machine learning jargon, these systems are less susceptible to overfitting. So overall, what we're building here is a system that includes multiple individual classifiers that look at the entire stock universe, and they each vote individually, and we figure out a way to combine all their votes together into an overall effective system. Well, so the next question is, what are factors? We mentioned that the name of the system is MultiExpert Factors, and you're probably familiar with at least technical factors like momentum, if you're a momentum trader or day trader, for instance. You're probably very familiar with technical factors. Those of you who are more familiar with fundamental factors have heard of things like PE ratio, EBITDA, and so on. Well, all of those are aspects or properties of a company that we can get quantitative information on. So each day in history, we can ask, okay, what is the volatility, what's the recent volatility of that stock? What's the 52-week high? What's the PE ratio? These are all quantitative, numerical properties of a company that we can learn about each day. So that when I use the word factor or feature, that's what I'm talking about. And we look across a large universe of stocks, the Russell 1000, and we look at up to 650 of these features altogether every day in our analysis. Now, all of that information at once is probably too much to assess for any one person or any one expert to look at all at once. And so what we do is we create individual experts that just focus on a subset of factors. So within our system, a MELS expert is a single, fairly simple asset screen that uses several factors together to decide for each stock, does this look good or not? So we show an example there on the left of something that looks at PE ratio, beta, and gross margins. Now, each of the experts in our system works independently. It screens every stock in the universe and decides, hey, does this stock pass my criteria for something that looks good or not? And by having many experts within our system, some experts are able, essentially end up specializing in different sectors of the market or different types of potential excess returns. So we might have an expert that learns to select financial stocks. We might have another expert that learns to identify momentum stocks. And we take all of their input together. Now, I show a picture of people over here to the right, but I want to emphasize that our system, doesn't involve people. It's experts that are generated using machine learning. Now, altogether, I mentioned that we have 650 factors in our system, in our database, and that's going up every day. We're adding more and more factors, and what that means is for each stock, for each day in our universe of 10 to 13,000 stocks, we're recording all of those factors every single day. Now, for this particular system, we're just looking at the Russell 1000 as opposed to every asset in the United States, but still it's a tremendous wealth of data that we're analyzing and processing each night. And by the way, as long as I'm on this topic, the way our system works is at the end of the day, we collect all of this data, we run our analysis overnight, and publish the results of the analysis before market open each day. Anyways, show here there's potential for 176 billion different combinations if we just use 4 factors for each possible expert. So the real problem for us is how do we, well, there's 2 problems. One is, given that we have a set of experts, how do we choose to value their expertise? In other words, is there some way that we can recognize that an expert isn't working so well and maybe not count its input so much? Separately, can we recognize when an expert is working really well and maybe value it some more? In the same way that you might pay more or less attention to different analysts covering different stocks. Then another question is, how do we figure out how to add new experts, new better experts to this system to improve it continuously over time? And that's something we're always striving to do. Now, one thing I want to talk about that is really a core technology that we rely on is something called event analysis. And you see a chart here that is the result of one of our event analyses. So recall that an expert uses 3 or 4 different factors, and the way the expert works is that for each stock, for each factor, it checks to see, okay, is that first factor between these 2 bounds, these 2 thresholds that I've previously set, and is the next factor between those 2 bounds, and is the next factor. And if for a particular stock all of those criteria are met, then we say, yes, this expert gives a thumbs up for this stock. Now, it's very much like a stock screen. You're probably familiar with stock screeners. But what we provide additionally, what we're able to do with this event analysis is we're able to look across a broad universe of stocks, across a broad set of time, to see on average, if we pick a stock that meets this criteria, what does it do? And so what you're seeing here is this vertical line, this dotted line, represents the date, essentially the zero date at which a stock happened to pass our criteria. And then you see going forward, on average, how does a stock perform? So over several years, over 1,000 stocks in a universe, we're going to have many, many days for many, many stocks that meet this criteria. And this analysis lets us look at it in aggregate. So as an example, this particular event shows that on average, the price of a stock after the event goes up something like 2% over about 17 days. And this chart along the bottom shows you, well, how many days into the future we're looking at, and also a comparison of the percentage of stocks that have succeeded over that time versus lost. And we utilize this analysis in selecting our experts and training them and so on. And this is available, by the way, on our platform, QuantDesk. Okay, now let me show you a few example experts. And these are ones that are actually part of our MultiExpert system. This one we call, it's Expert 1, and it has 3 factors that it looks at. So it looks for a PE ratio between 15 and 20, a beta between 0.75 and 1.5, and as you can see, gross margins between 45 and 85%. Now, in our analysis, we have found that on average, historically, stocks that pass this criteria return about 1.4% over 42 days. And you can see the chart to the right that illustrates that. So that's one of our MELS experts. Here's another one. This one is even a little bit simpler. It's just got 2 factors. We look at average price volume rank. That means we're comparing every stock to every other stock in our universe. And we want it to be below 0.45. So what that means is we're looking for, among our large universe, which is very liquid, by the way, Russell 1000, but we're looking for those that have had, or in the lower half of price volume over the last 21 days. And then we also are looking at analyst recommendations. So those are 2 example experts. I'll show you one more. This one uses 5 criteria. One that's especially interesting here is Greenblatt rank. You might be familiar with Joel Greenblatt. He's created a tool for analyzing stocks and ranking them. And in this particular case, we're looking for a Greenblatt rank in the lower 50%. I won't go through all the particular details, but one of them that I wanted to point out here is this DWA signal that is from Dorsey Wright, which is one of the other data providers through the Analytics Hub. Now, I'd like to pause for just a second and see if we've got, before I launch into more detail, I just want to see, does anybody have any questions about, what are these particular experts and how do they work? I see one question, why is the selected holding period different than the, why is the selected holding period different than the suggested holding period? Well, a part of our data feed for each stock that we analyze, we actually provide a optimal holding period if you're choosing to hold that stock. So we look across all the potential holding periods and all the potential returns, and essentially how confident we are in achieving those returns. And so, for instance, if we're less confident about a 42-day hold than a 1-week hold, we measure that, we weigh that also in conjunction with what's the projected return, and we combine all that into a recommended hold time. Another question is, what's the source of the factor data? Lucena Research has a number of data providers. Our key data provider is a company called Premium Data. They provide our fundamental and price history data. We additionally ourselves process that data to generate all of our technical factors. Okay, I'm going to move on. We'll continue to collect the questions and pause again in the future to answer some more. Now, I wanted to make a concrete example so that you could see how all these experts work together in our system. So we rolled back time to April 1st, 2010, and we looked at 4 particular stocks: COP, CPA, CR, and CSX, and looked at, on that day, for 2 of our experts, what happened. So you can see here, so each column represents 1 stock. Each row represents a particular factor that's part of an expert. So you can see, for instance, here, COP, it failed the price volume rank criteria for expert 1. And so because it's necessary that it pass all the screens, it ends up failing for expert 1. Similarly, COP also fails for expert 2. So COP is not going to get a vote from either of these experts. Now, if you look at CPA, it passes both of the criteria for expert 1. It fails one of the criteria for expert 2. So it's going to get a vote, positive vote from expert 1, but no vote from expert 2. And then, as you can see here, CR ends up passing the criteria for both of those experts. So remember, again, each expert sort of decides pass or fail, just simply. It's not putting out any sort of prediction or forecast. It's just deciding, hey, does the stock pass my screening criteria? And the idea here is that if we have many, many experts, we're able to build a system that is able to identify opportunities in particular segments of the market. And if you see that multiple experts, like a particular stock, there's probably multiple reasons that it's likely to succeed going forward. So on April 1, 2010, this is how our experts would have voted. Okay, so how does that work into the overall system? So here's how that works. We have our multiple data feeds coming in here, and of course we process them and turn them into our factors. Then that data goes to each one of our experts, and each expert, like I said, determines, okay, does this stock pass my criteria or not? So each line here down below indicates a positive vote for a particular stock. So remember, expert 1 decided that CPA passes its criteria and also CR, and expert 2, CR also passed, and expert 3, CR also passed. Now, there's an additional part of the puzzle here that I hadn't mentioned before, which is we choose weights for our experts. So each expert is assigned a weighting depending on how accurate it's been in the past. So the experts that have really been on fire and making good predictions, we give higher weights than the experts that have not been predicting well recently. And in fact, experts that are especially poor may even get a weight of 0. Now we always keep the experts around, and each day we analyze, okay, is that expert coming back into favor? Because the value of different experts probably waxes and wanes according to the market regime. So they didn't get into our system in the first place unless they were good at something, but it may be that, for the moment, the market regime isn't serving their expertise well. So as I said, each day we assess, okay, how good have they been recently, and we accord them those weights appropriately. So a couple things to look at here. Okay, so we've weighted our experts, they've given the votes, and then down here along the bottom you can see the resulting sum of votes. So CR has multiple votes from experts that have reasonably high weights, so it's going to get a overall high vote, whereas COP here got no votes at all. So we look across our entire universe, we put together all of those votes, and then for each expert that has for each stock in our universe that has a vote, we have a number. And we basically are able to, sort those stocks according to the votes and, rank them from highest to lowest. And this is what comes out in the data feed. Now, something I didn't mention is that we have a entirely separate set of experts that look for shorting opportunities. So they are created and trained separately from the long experts I just showed you, and they are looking for factors that predict a stock going down in value. Now those experts provide negative votes. So we then combine the positive votes for stocks we think are going to go up with the negative votes for the stocks that we think are going to go down, and then we get a ranking across the entire universe. One thing to mention is it may very well be the case that some stocks don't get a vote either way. So in our data feed, that's represented essentially as a 0 weighting, and it just represents those stocks that our system doesn't have a position on. Doesn't mean that shouldn't be interpreted necessarily negatively or positively. It just means that of the experts that we currently have, there's not a strong positive or negative sentiment there. Okay, let's take a look at questions we have, and we'll pause for a second to take those questions and then move on. Erez, are there any particular questions we ought to take a look at?
Tucker, I have no visibility to questions coming in, so I don't see any. Maybe
okay.
You have a different.
Okay, I'll take a look through the ones I can see here. Just a second. Sorry, I'm just taking a look through the questions we have and going to pick out the ones that I'm able to answer easily. So one of the questions is how are the criteria for an expert determined? By human expertise or totally data-driven? That's a great question. One of the things that I think is very powerful about our system is that we are able to include experts that are based on human insight, and also to create them totally driven by the machine. So the experts that are part of our system, some of them have been created with guidance by humans, and some of them are created entirely by machine learning. We have seeded our system with a few experts that were created with human guidance. And what I mean by human guidance, by the way, is our system enables you to start with a hypothesis. Okay, I think this particular factor is predictive. Let's assess that using an event study. But then you can ask the system, okay, given that I think, it seems that this factor has promise, what other factors could I add to this scan that would make it more valuable? So our system takes the factor that you've already plugged in and its thresholds, but then it looks across all of the other 649 factors to find the one that, if you added it, would improve the system the most. So all of our experts are either completely generated by machine learning or human generated, but with machine learning guidance to make it better. In terms of how the thresholds are determined, those are set by machine learning. I'm just checking on a few other questions here. There's be more discussion about how we train the experts in just a moment. So there's a couple questions about that. Okay, most of the questions concerned how do we pick the factors, and I think I've answered that. So I'll go on. Now, I mentioned just a moment ago that we look at how well the experts have worked historically, and we use that information in order to weight the experts. I'm going to talk for a moment now about, how do we evaluate them and determine these weights. So what we do is we look back historically. Present day in this chart is all the way to the right, and we ask, okay, suppose we had complete foresight. We knew that the stock was going to perform in this way. What would have been the best times to buy and hold the stock? So you can see here there's a couple positive stretches for Apple, and over this entire time period, it would have been best if we had bought here, exited there, and then again bought here and exited there. Now this analysis includes transaction costs. So if we did not include transaction costs, it would always be optimal to just buy and hold for a short number of days as opposed to holding over longer periods of time. In general, the reason that we want to hold for longer periods of time is to avoid the costs of, the transaction costs of churning. So we're considering transaction costs, and that's why, for instance, you don't see a buy here and an exit there, because overall it was worthwhile to hold the stock through that slight downturn all the way up to here. Now, the higher the transaction costs, overall, the longer is sort of the optimal holding period. So when we look back over this time, we know, okay, that would have been ideal. That would have been the best time to buy and hold. Now we compare that with what did the expert that we're looking at choose to do. And you can see that this is just a hypothetical example, but you can see here in orange, what this particular expert chose to do didn't exactly line up with what was perfect. So we look for those differences, which you can see here in red. Those are times where this particular expert that we're analyzing didn't do what was optimal. Now, of course, it's very hard to do what's optimal unless you can see into the future. So we don't expect any expert to do what's optimal all the time. And in fact, that's why we have multiple experts, because some of them do better in different times than others. But in terms of assessing, okay, how well did you do recently, this is how we make that judgment. So we look at all of our experts over previous 3 months, and we assess how well did they do. Each of them gets a score according to this criteria I just showed you, and that's how we set their weights. So now an important question is, how do we find new experts? So we, suppose we have a system already with a certain set of experts. How do we find new ones to add? And by the way, we're constantly running our machine learning software to find new experts, and we're adding them to the system. So the system, MELS, is continuously improving. But how do we do that? How do we find the new ones? So we use something for machine learning called boosting. And here's the way that works, is we take our existing system here in this green box, we roll back time, and we check each day, hey, how well did you assess each of the stocks in our universe across all these days in history? And we compare that with, like I showed you on the previous pages, we compare that with what we knew was the correct response. You know, if we had foresight, what should we have done? And we find those differences, and that identifies errors. You know, that helps us identify the opportunities that we missed. So we take those missed opportunities and we use those to seed our system to find a new expert. And in particular, we're seeking an expert that's able to do well on these opportunities that we missed. And this process can take days. We use something called a genetic algorithm. It can take quite a long time to come up with a new expert. But once we find one that fills in some of those gaps that we identified in this analysis, we add that new expert to the system. And as I said, this is a process that's running continuously within our system historically. Okay, so here are a few back tests to look at. One thing to mention is there are two data feeds offered. One is long only, so it's just the long side of this long short system, and we offer separately a long short offering that includes also the short side. So historically, this is performance of the long only, and I believe this represents buying the top decile and remaining in the top decile as we go forward over time. One thing to mention is some of this data is in sample, but we're purely out of sample since 2016, and we are doing quite well since 2016, still outperforming the benchmark. This is the long short. So now, in addition to just considering the long votes, we're considering the short side as well. So we've got a balanced portfolio. It's balanced dollar-wise. We invest an equal amount into the long side as into the short side. And you can see very low volatility, low drawdowns, and so on. Oh, and I didn't mention the strategy we're reporting here is in orange, and the benchmark, which in this case is the a hedge fund benchmark, is in blue. Okay, so that concludes the things that we wanted to talk about. Let me now let's consider some questions, and I'll pick a few here. So this is a question from Brent. Are there studies on expert-based portfolios that omit certain experts so that based on some criteria they remove an expert from their pool? So I'm not sure if you're referring to academic studies or not, but certainly it is the case in our system that experts that are performing especially poorly will eventually get a weight of 0, which is like them being removed, at least for the the current voting. We always keep them around though, because they may become good again. Which factors are considered to design the experts? This is a question from Vamshi. We can for MELS we consider technical factors, classic fundamental factors, and also factors available from Dorsey Wright. And these are all, again, part of the Nasdaq Analytics Hub. We are investigating the creation of an additional data feed that will utilize all of the factors available through the Analytics Hub. And once we've got that one perfected, we'll have an additional presentation talking about that. Next question from Ryan. Is there a sweet spot in terms of signal decay relative to your expert inventory in general? And then relate this back to turnover if implemented as an active strategy. So the one thing to mention is this particular system is targeted at 21-day holds. So we've kind of optimized the system. When we see a strong positive signal, we're looking for that return to mature over 21 days. Now, the backtests that I've showed you do include transaction costs, but in particular, we don't specifically analyze signal decay. Okay, let's see if we have. So one of the questions, Oliver, are you available? One of the questions concerns sentiment analysis.
Mm-hmm. Yes, I'm here.
Maybe we want to talk about the on the Analytics Hub, some of the different data that's available there. In particular, we've got a question about sentiment analysis.
Yeah, so we have a partnership with a company called iSentium, and they are experts in natural language processing, and they process the Twitter feed along with StockTwits and Facebook, and run it through their algorithms and have basically sentiment factors that then they publish. And in partnership with Lucena, we provide some value-added fields like ideal time to hold and different and an assortment of other ones as well. And so that's one sentiment source that we have via iSentium. And then we also have a partnership with a company called Predict Wall Street, and they've got a really interesting business model where they post basically voting widgets on an assortment of websites with retail audiences. And so retail investors then, when they're looking up a quote, can vote whether or not they think Apple will go up that day, and then will go up over the week and over a month. And then based on that, they run it through algorithms. Well, and they'll share as the investors vote, the results are shared so they can have an idea about how accurate they are and how their votes stack up against sort of the broader crowd. And then based on that, the Predict Wall Street folks sort of determine the overall sentiment of the equity, and we'll publish that. And again, we provide some value-added analytics on top of that and make it available via the hub. So those are two of the sentiment products. And then we also have a partnership with a firm called Prattle that looks at central bank communications, and they sort of process that via natural language processing and determine whether or not the communication was hawkish or dovish, and give a score associated with that as well. And that's really we found a lot of success with that with more macro looking traders. And then finally, we have some sentiment related to sort of information based in corporate filings through a company called 281st Data, and they process basically all 10 Qs and different other corporate filings as well. And basically they'll look through the detailed notes, and they tend to pick up tidbits about the stock that are indicative of whether or not the stock's going to go up or go down. And so we publish signal associated with that as well. So I mean, we've got a whole assortment of sentiment type products, and we obviously plan to add more as we speak to clients, determine the demand, and then also work with third-party partners in terms of what they have and validate the quality of it. So, sorry, that was a very long-winded answer.
Oh no, it's great to the opportunity to cover all, well, a lot of the sources that are part of the analytics hub. And my understanding is that Nasdaq is looking to grow that. The target is to have 100 such sources, I think, in the coming year. So they're being added rapidly. Now, one thing I want to add is each one of these data sources that's offered through the analytics hub, Lucena analyzes it, provides backtests and puts a machine learning layer on top of it. Sometimes the individual data providers don't exactly have a way to go from the data to an actionable execution plan, and so in conjunction with Nasdaq, that data and Lucena, we create a data feed that in most cases provides a actionable plan. You can look at our analysis to determine when it makes sense to execute or not. Now, this particular feed, MultiExperts, as I said, focuses on Dorsey Wright data, which are technical signals, an additional wide set of technical signals and fundamentals. But the sentiment data that Oliver just was talking about is also available through Nasdaq's Analytics Hub with our machine learning value added there. Now, I wanted to address two other questions, and then we'll wrap up. One question from Omar is, how do you know you are not overfitting or finding spurious relationships? So that is a very important question that always crops up in machine learning and data mining and so on. And one thing I wanted to point out is, at least anecdotally, the most sort of overfit kind of model is a single model that has many, many criteria. So a single model with, say 10 factors and very specific thresholds on those. Historically, it's somewhat easy to fit a model that would do well in sample. But if you go forward out of sample, you'll often discover that a model with many, many, many features tends to have overfit. So you can find something that works great historically, but isn't going to work well stepping into the future. Summarizing, worst, most overfit situation is a single model with many factors. What ensemble learning brings to the table is lots of experts with a very few number of factors. And it's been shown over and over again in research, machine learning research, that a small number of factors is much less likely to overfit. I mean, it's still possible to overfit, but it's much less likely to overfit if you have a small number of factors than if you have a large number of factors. And it's also, in ensemble voting, it turns out that adding more experts reduces the probability of overfitting. So to answer the specific question, which was how do you know you're not overfitting? The answer is we're able to assess that by going forward in time and observing the performance of the system. To some extent, you can never know for certain historically that there isn't overfitting happening there. So we always recommend forward testing and observing the system as it goes forward. Now I'll answer one last question. And by the way, if we didn't answer your questions here live, we have all your questions recorded, and we'll follow up with that with you by email. But the last question is the exit always after 21 days, or are the experts also used to determine the moment of exit? So indeed, we are, for this particular strategy, when an entrance is triggered, we do hold it for 21 days. Now that's in the backtest. Now that's not to say you can't take our data feed and use a different implementation. you will know every single day what the particular votes are for each individual stock. And we have seen that, yes, if it falls out of favor, it can make sense to exit. But the particular backtests you're looking at here involve holding for each of the individual optimal holding periods. Okay, let me wrap up, and please, if you have any questions that occur to you later, send them to the email address you see there. We'll be glad to follow up with you. And for everyone else who posted questions, we will follow up with you by email on those questions. And thanks, Oliver at Nasdaq, and thank you out there for listening to us, and we look forward to connecting with you in the future. Thanks very much.